crisis and was back to its pre-peak levels within 11 months. Exports, however, continues to underperform relative to production. Now, the reason why we're seeing this dramatic turn up in Asian industrial production is in the right-hand side. And this is automobiles produced for China and India. It's also automobiles sold, because 98% of vehicles produced in China are sold domestically. And what we can see is that around exactly the same time we saw Lehman's go bankrupt, September 2008, we saw a dramatic takeoff in vehicle sales in both China and India. This reflected two dynamics. First, companies such as Geely and Tata in India were moving into the production of automobiles for the very first time. Tata produces the Nano, which retails for $1,900. Geely has a number of vehicles with subsidies below the $1,500 price point. So the dynamic that was occurring around the same time investment banks were moving into their financial crisis was that China and India had moved out their production possibility frontier and were producing these highly elaborately transformed manufactured goods for the first time. And what we've seen over history is that when economies move out their production possibility frontier or move into a new industry, they tend to stay there for a while. Unless you see something catastrophic, like the collapse of the Soviet Union, you don't see the production possibility frontier move back in. So what we're seeing is China and India are producing these much more elaborate goods for the first time. At the same time, China and India are moving into a demographic sweet spot. Family unit formation is probably starting to peak. We're seeing continued growth in middle income families. And as a result of that, there is the demand domestically to absorb this production. And if we look at the latest figures for China and India, and we combine them, the current run rate for vehicle production is around 25 million units annually, and that's more than Japan, Germany, and the US put together. So this dynamic is very, very important because it's allowed the Asia supply chain to redirect and retool very, very quickly. Though people will sort of, defend passionately what is the ideal car, be it a Citroën, a BMW, a Mercedes, a Buick. The reality is that there are a lot of generic components that go into all vehicles. A steering wheel is a steering wheel. And as a result of that, what we've been able to see is the Asia supply chain has been able to respond to what has been an inter-Asian dynamic and re-gear its production very, very quickly. Just to offer some concluding thoughts, it is important to note that the nature of Chinese growth, though very strong, is becoming more unbalanced. And if we look at China's growth over 2009 to 2010, it really has moved into a fourth wave. And this graph basically just shows the contribution investment has made to modern economic growth since 1978, when Deng Xiaoping declared that poverty is not, or socialism is not poverty, to be rich is to be glorious, and plunged the economy headlong into reforms. We saw the first real strong wave of investment occur immediately after that. Investment rose to account for about 83% of economic growth in 1984. The second wave occurred in the 1990s when we saw the creation of the special economic zones in Guangzhou and Shenzhen. Again, economic growth or investment growth rose to account for about 80% of GDP growth. The third wave occurred in the lead up to and immediately after World Trade Organization ascension, and the fourth wave is now. And over 2009, investment accounted for 93% of GDP growth. Now, you cannot have one component of expenditure growing that strongly without it crowding out other components of growth. And what we're actually seeing in China is consumption share is falling as a result. Given China imports a lot of its infrastructure and investment goods, the economy is moving into trade deficit as a result. So these investment waves, though powerful when they occur, do have dislocations within the domestic economy. Just on an interesting chart to look at, when you're reviewing the chart pack afterwards, which you can download from the internet, of course. When we look through the stimulus package again, we find that of the announced measures that we saw in November 2008, China is broadly around 30 to 40% through them. In terms of economic housing, in response to property price inflation in China, China has responded with a massive volume response. It will build around 3 million units this year and upgrade a further 2.8 million. So that's activity around 6 million units. In terms of railways, China is aiming to add 15,000 kilometres of track. That's high-speed track during the next 3 years. To put that in context, President Sarkozy in France wants to double the size of the TGV network from 2,000 kilometres to 4,000 kilometres by 2020. So obviously what we're seeing in China is a very powerful dynamic. Now, obviously, the story with China is a powerful one at this stage. We believe, obviously, the endogenous momentum of the Chinese economy is very, very strong, given this investment dynamic. But the key question is, can China save the world? Because obviously, European growth is adjusting to a new lower level. The US still has its painful workout to reduce excess debt levels. In fact, the OECD does. The latest estimates from the IMF are that OECD public debt to GDP will peak at 110% over the next decade. So when we look at China's growth and we put it in a relative sense, we still find that China's consumption is only 18% of US consumption, 24% of European consumption, and 50% of Japanese consumption. So if you're seeing less subsidies to consumers in the developed world, more taxing of consumers in the developed world, China can't make up for that shortfall. It's just arithmetically impossible. On investment, however, China's investment is already around 80% of US investment, 65% of European investment, and 145% of Japanese investment. And we have the situation where investment is growing 30% nominal terms, around 40% real terms per year. So what's currently happening in the global economy is China is overtaking the US and Europe and Japan to become the world's single largest investor or capex-driven economy. And that's going to be the key to how China plays out for the global economy. It's not going to make a difference in the global consumption space. Where it will make the difference is in the global capex and infrastructure space, which is why the economies that will benefit from it are relatively limited. In fact, we think there's about 5. The capital exporters of Asia, Japan, South Korea, and Taiwan, and the bulk commodity exporters of the world, Australia and Brazil. Finally, just one other point, when we take a longer term view and look at the sort of path to normalization of these extraordinarily easy policy settings which we see around the globe at the moment, all we've done here is just put our estimate of the output gap, so how much economies are growing underneath potential, against when we expect them to make their first vanilla move on rates or to hike interest rates. And the sequencing is very important because it tells a story. The first economies to have moved on interest rates are your commodity economies. And not surprisingly, that reflects this very strong commodity dynamic.